director's cut, reefing the sails, which is what sailors do when they get into a severe storm or a lot of wind. And that's what industry is doing in North Dakota right now.
Okay. Let's stick with the federal policy theme. Any thoughts on the BLM and their regs on paying royalties on flared gas?
Well, that policy, of course, was put out there, and the North Dakota Petroleum Council would be the source to talk to about that, but they have filed in court for an injunction on that requirement, and I think they have until the end of this month to pay the 7 years of back royalties under the policy. So they've asked the court for an injunction against that while they work it out in court, and that's about as much as I know about it.
Okay, that's why I didn't know about it. In December 2014, at the peak of activity, would you have any idea about how many operators were operating with double-digit rigs?
Prior to the 100 rig reduction, I believe we had 4 operators who were operating with double digit. If you give me just a second, I'll look at my list here. Burlington, Continental, Hess, and Oasis were all in double digits. So yes, I think we had 4 and Whiting as well. So we actually had 5 in double digits, and we now have none.
What specifically has changed, you think, since the July call when North Dakota production was about 1.2? You thought it would stay steady or stay level. So has that really changed? And if so, what has?
That really hasn't changed significantly. I mean, I realize it's a 20,000 barrel a day drop, but we're still just a shade under 1.2 million barrels a day. I think the big change is operators' realization that we're in this for a longer haul. And the other factor that I've been reading about is that operators had hedged their production in the oil markets, and most of those hedges expired in the third quarter, and so they have gone out and re-hedged, but instead of at $90, they're now putting hedges in at $50 or $60. So I think that reflects an attitude of leaving the oil in the ground, not producing it, and voluntarily reducing production as well as rig count, and leaving wells non-completed in this low price environment.
Yeah, so that actually was kind of a two-part question for me. Does that have a connection with the wells waiting on completion? And also, I guess what's kind of bringing about the rule thingy we're going to talk about later this month, the Industrial Commission, about that? You can make a nice explanation for what that is and why.
Sure. Two-part question. One is there a relationship between the lower production and the wells non-completed? And very definitely, we're at a record level in terms of wells not completed. 993 is the highest it's ever been historically, and we talked last month, still anticipate that going well over 1,000 as we push forward. One operator has indicated to me they plan to keep their high efficiency rigs and keep drilling wells, but if they can, they're going to run 0 frac crews and just build NC status wells. So then that leads us to what should the policy of the state be going into the December through March timeframe, when the NC status on a lot of wells is going to be expiring. Current policy is that unless a working interest owner or a mineral owner or a surface owner files an objection or calls in emails with an objection, registers an objection with the commission to grant the temporary abandoned status, which extends that non-completed status for a year. The philosophy is that at these low oil prices, it's better not to produce the oil, not to tax it, and not to add it to an already oversupplied market. But we want to be sensitive to mineral owners and surface owners and working interest owners who may have a problem with the well staying not completed. So that'll be the discussion we'll be having on the 22nd, is whether that, in fact, is the approach that the commission wants to continue with.
So could you just explain more about what the current rule is with once you drill a well, how long you have before you have to complete it and what the penalties are if you don't?
Sure. Question was, how does the current rule work once you drill a well, and what are the penalties? So once a well reaches total depth, and we record that date in our database, our field inspectors record that, then the well can go for 12 months without producing in paying quantities. That's the statutory limit. If a well reaches that point, then the law requires the company to temporarily abandon the well, put it on production, or post a full plugging and reclamation bond. So the penalty for going beyond that, there could be a civil penalty, but the more obvious penalty is that there'd be about a $200,000 bond would have to be posted for each well left in NC status. If they file for temporary abandonment and it gets approved, then that extends that time an additional year, so it can go out to 24 months. And that 1 year time frame, they're actually allowed 6 months to do something with the well. So really the 1 year turns into 18 months. Although they're in violation at 12 months, the law actually allows them 6 months to take one of those corrective methods. So it's a 12, an 18, and a 24-month clock.
It's laid out in 3808, 04, 1, L.
Yes.
Thank you.
Is there any reason maybe why one in MC status wouldn't be granted the temporary abandonment one?
Yeah, the question was, is there any reason that a well in NC status wouldn't be granted temporary abandoned status? And as I stated, the way it works right now is if a mineral owner, for example, someone who would be receiving royalties off the well, or another working interest owner were to object to that 1 year extension, or a surface owner for one reason or another, perhaps it's the only well on the site and they want the site reclaimed, then those three reasons would trigger more than likely a rejection of TA status.
Given all the things we know about production scenarios, what is your outlook for the rest of the year?
I really expect a slow decline in production. The legislature set the planned production rate at 1.1 million barrels a day throughout the biennium, and if we don't see price improvement, then we're going to decline down to 1.1 million barrels a day by the end of the biennium. In fact, if we see any degradation in prices, and that's the big wild card, we could actually get down to closer to 1 million barrels a day by the end of the biennium. So it really all depends on what happens with prices and these hedges. The top 10 companies, and I've visited with almost all of them, have reduced their well costs and their operating costs enough that they can maintain production at $50 West Texas Intermediate. They don't really want to grow production until WTI reaches 60, and they certainly are prepared to let production decline if prices go significantly below that $50 mark. But they're all set up to maintain production at $50.
And uncompleted wells, TA status wells, that's all on a case-by-case scenario. It's not like a blanket situation sort of thing.
That's correct. It'll be a sort of a blanket policy that the Industrial Commission will agree to or agree to extend, but every well is looked at individually. So each and every single well will require a sundry notice justifying the temporary abandonment status, and every one of them will be looked at to see if any kind of objection has been received from the other parties that are involved other than the operator.
Are there a lot of objections or to TA requests?
Objections are rare, and in fact, I spent some time this last month visiting with what we call non-ops. This would be the companies that own a working interest in wells but aren't the operator. They may own anywhere from 10 to 40%, or maybe just 1 or 2% of the well. And the 5 non-operators that I talked to 100% supported TAing and extending. They didn't want to produce their oil and sell it at this price either.
Are there risks to well integrity for leaving wells uncompleted for that time frame?
I'm glad someone asked that question, because I meant to say that there is a fourth condition. It isn't just mineral owners and working interest owners and surface owners, but they have to prove that the wellbore doesn't leak. So the well will have to be pressure tested and a plug put in the well to make sure that the wellbore can't leak during that 1 year time extension. And so there's a cost, probably $50,000 just approving that, if they go that route as opposed to putting it on a single well bond. So no, we carefully review the wells as they're drilled and constructed, but in order to extend that NC status, they're going to have to prove that the wellbore doesn't leak.
Any approximation to how long you think the voluntary restrictions will go on?
Based on what I hear from operators and from the midstream company, we're probably looking through the end of January, because the Lonesome Creek plant is scheduled to come on in January. And so until Lonesome Creek comes on, we're going to see continued restrictions in capacity at the compressors and at the plants.
And that's a one-oak plant, correct?
That's a one-oak plant, yep.
Okay. Ellie?
Oh, are you concerned at all about, I know in some other states, some of my colleagues in Wyoming are looking at companies and their bonding requirements and not having enough cash on hand to pay for well cleanup as the price of oil is low, being able to manage that with also servicing their debt. Are you running into any issues with that so far here?
We haven't seen any issues develop. The question was about bonding and companies running out of cash and not being able to manage abandoned wells. And we haven't seen issues in that area yet, although we do have a couple of companies who have filed bankruptcy.
Right.
And so I'm still waiting for the analysis from the Attorney General's office on where that puts us with regards to being a lien holder on the well. We are clearly, the state is clearly the recipient of the bond, but the bond is not adequate to pay the full plugging and reclamation cost for the well. We started managing this years ago by limiting the number of abandoned or inactive wells that a company can have on their bond. We don't have a limit on the number of TA wells. So that is one of the rules that we're reviewing to see, should there be a limit on the number of temporary abandoned wells that you can have on your bond, and are the bond amounts correct? They haven't been changed for, I think, about 6 years. So that's one of the things we're looking at in our rule revisions is bonding.
Okay. I think I've got everything from the webinar. I'm trying to scan through them, so if I missed anything, let me know. And I'll give it a few seconds, but I think we got it all covered.
All right, thank you. Nick had another question.
Oh, go ahead.
One more.
Sorry.
Yeah, fire away.
With this production restrictions you were talking about until that plant comes on in January, what kind of impact could that have on flaring? Could we see like more production curtailments or whatnot, or anything like that? Or is this about where we're looking to stay at?
Yeah, the question was with production curtailments and voluntary curtailments and that to try to stay within the flaring goals. I still think that we're going to see our capture deteriorate some. We're at 80%, and I really believe midwinter, about the time that Lonesome Creek plant is supposed to come on, we may drop into the upper 70s. We may get down close to that 77% goal before that plant comes on and we turn the corner and start going back the other direction. Of course, as you know, the commission set a goal of 80% for April 1 and 85% for November 1 of next year. So, but I think we're going to drop into the upper 70s before the thing turns around. And I expect that companies are going to continue, especially with the low oil prices, they're going to be willing to sacrifice some production in order to stay above those goals and not have state-imposed production restrictions. So we'll probably see 10,000 barrels a day or more of voluntary production restrictions on the part of operators.
Just a quick follow-up on that. Have there been state-imposed production restrictions so far?
Yeah,
for flaring?
The question was, have there been state-imposed production restrictions for flaring? And yes, there have. I don't have the numbers off the top of my head, but I think they've ranged anywhere from 500 barrels a day for a couple of operators up to 4,000 or 5,000 barrels a day for several operators. But we could get you those numbers. But there have been restrictions imposed almost every month since we started tracking it.
All right, that's all I have.
Mr. Helms? Mr. Helms? Mr. Helms?
Mr. Kringstad, get some up here.
There we go.
Thank you. All right.
Okay.
That's okay.
Well, good afternoon, everyone. Justin Kringstad, Director of the North Dakota Pipeline Authority. We'll get right into the updated material. And so, as you heard from Lynn, the updated North Dakota production figures, I've not been able to receive any recent months for eastern Montana and South Dakota, again, lagging but still hovering around that 4,400 barrels per day. So it'll be interesting to see in these coming months if we see a similar trend taking place in Montana. Right now, they're currently at one drilling rig on the eastern portion of the state. So my estimations are that we may start to see some slipping in production on that side of the border as well. An update on slide 3, taking a look at how the crude oil was moved out of the region. Again, very small change from month over month. No big changes in either pipeline activity or rail activity. You can see probably the one noticeable uptick would have been on the green portion, that truck to Canadian pipelines, and I'll cover that here in a moment. But other than that, pretty consistent market share for the summer with that pipe and rail and refined distribution. How this looks on a chart, again, you can see in purple and in blue, again, we had very slight movements month over month on pipe versus rail. Very bottom, again, that little green uptick on the crude oil that was being exported by truck onto the Canadian side of the border. On the overall volumes, again, fairly steady, estimated what was leaving the region by rail car. No big changes that I saw in any of the data or any of the trends. And so, again, very consistent throughout much of the summer months, hovering right around that 600,000 barrels of oil per day leaving by rail car. Destination information is, again, consistent. Most of the crude oil leaving by rail heading to the East Coast. Again, just minor fluctuations on the West Coast and the Gulf Coast as well. Likely just triggered by what was taking place in the oil pricing markets for those different destinations during the month of August. For July, this is the most recent month. Again, just an update for everyone as far as what crude oil pricing looked like during that time period, what refineries were paying. Again, following suit with the percentages of where that crude oil is headed. You can see again, East Coast and West Coast having the highest priced markets for that crude oil, followed up by the Gulf Coast pricing. Where we sit today, we have seen a pretty tight, relative to what we've seen in the past few years, a pretty tight price differential between that Brent and WTI pricing. So it's been hovering in recent weeks right around that $3 spread. And so that's, kind of an indicator of what we've seen historically is that if there is a barrel that does have some flexibility to it, it's likely going to be choosing at this pricing point, fill up the pipeline option first, go to some of the more traditional markets, and then look at going on a rail car if the pipeline option is not available. And just slide 9, just again, just a quick update on those truck barrels going across the border, both directions. Uptick in both imports and exports, and so I'll have to keep watching this trend here. Off the top of my head, I don't recall any events in August that would have caused that export number to increase. Having now just gotten the numbers, I'll have to take a little bit deeper look to see if that's something that we can expect to continue, or if this will be a marketing blip in the data, and that we'll see it go back down to more historical trends. So I will be watching that coming up here in the coming months. Slide 10, getting into the flaring percentages, really no change. We saw just a 1% increase on the percent of gas flared from wells that were connected to a pipeline. So again, that continues to be the major challenge with natural gas flaring, or wells that are connected to a pipeline system, but just not enough space or compression or gas plant capacity in order to get all that gas moved and marketed. And then slide 11, just an update on getting those wells connected. And so we have seen that number trend downward. And so, what I gather from that chart on slide 11, when we look at where the challenge is, it's really on getting expansion work done on the existing pipeline system. So coming into the downturn, I didn't really know what to expect if we were going to continue to see new wells getting connected as fast as they have historically, but it would make more sense, just intuitively for those gas gathering companies then to spend that capital, those resources on expanding existing infrastructure, because that's really where the challenge currently lies in our gas flaring situation. So, looking at the numbers, we do see that decrease in number of new wells that are getting connected, but again, I think it's twofold. We've seen less drilling activity, and at the same time, more of a focus on existing assets, getting additional compression, getting additional pipe in the ground to expand those systems to address the larger piece of the flaring pie. So with that, I'd be glad to answer any questions.
Going once? Hold on, there might have been one that snuck through. Let me make sure. Oh, there it is. Seems like a small uptick in crude oil trains. Do you expect more outbound when Phillips 66 comes online?
As far as the overall numbers, if we look at slide 5, fairly consistent. Again, these are our estimated numbers, and so they're not exact, but pretty consistent over the summer. When a new facility comes online, like the Phillips 66, I don't know, again, time will tell. I don't want to speculate too much as far as what that's going to do to the market conditions. If it will just pull barrels away from another rail facility, if it will pull barrels from a pipeline system, or how that's going to work. So I won't speculate too much on that.
Okay. All the questions here. Any questions in the conference room? All right.
Yeah, thank you.
Thanks for coming, everyone. Sorry about the little snafu with WebEx at the beginning. Glad you guys all made it on. So we'll see you next month. Thank you.